We have critical information you need to know before tomorrow morning. Tomorrow morning, we are going to get retail sales data, and this is critical in an understanding, is the economy headed towards a recession, or was a 10% correction in markets appropriate to factor in some of the uncertainty that we have seen? A lot of it coming out from Washington, but also from corporate America. The retail sales report tomorrow is going to be massively important to solidify this bounce, or we could give it up. We also have a new warning, if you will, from Treasury Secretary Scott Bessent, where he says he cannot rule out a recession, and America was on a path towards a crisis. And this is really Washington getting ahead of that crisis before it happens. We also have the summary of economic projections coming out this week with the Fed's new meeting. Now, Jerome Powell is going to speak, and you're going to get this SEP, and that's really going to be a huge catalyst probably for the next couple of weeks. We're going to react to this and any changes in that report. If you have not done so already, and you are a frequent viewer of this channel, hit that like button and subscribe to the channel. It helps push these videos out to a wider audience that I think needs to hear this. Now, also here in this video, I will share with you your big levels for Tesla. What could be coming next if this is a good week, if it's a really good week, or what happens next if this is a bad week, and what I'm doing to prepare for this. First and foremost, let's acknowledge the obvious. On Friday, the S&P was up 2%. Now, from the lows of Thursday, so really like bottom barrel market lows, to where you closed on Friday, you were actually up about 2.5%, give or take. You've already seen about a 2.5% bounce. Now, some people are calling for a between 3% and 5% bounce. So a 3% bounce is going to put you to about 566.50 on the SPY. A 5% bounce could take you back to about 577 or so. And that's possible. Okay, you could retrace 50% of this correction pretty easily. But you do need some things to go favorable. That is the Fed this week, and that is the retail sales report coming out tomorrow. We also have real estate data coming out this week, and that can be important in and of itself, because if real estate slows down, let's say prices start to fall broadly on homes, then people are going to get even more concerned about the wealth effect slowing down and people that stop spending money. Because the sad fact of the matter is 50% of all spending in the economy is done by the top 10% of income earners. Top 10% of income earners likely tie their spending habits to their asset prices, like their homes. So stocks fall, home prices fall, and that could trigger a lot less spending in the economy. First, before we get to your big catalyst of this week, this interview just came out from Treasury Secretary Scott Bessent. He says the White House is heading off a guaranteed financial crisis. He says, quote, "What I could guarantee is we would have had a financial crisis. I've studied it. I've taught it. And we had kept up these spending levels. Everything was unsustainable." Bessent said on NBC's Meet the Press, "We are resetting, and we are putting things on a sustainable path." But Bessent notes that there are no guarantees there won't be a recession. Bessent believes pullbacks like the one the market is in right now are benign, and Trump's pro-business policies will boost the market and economy over the long run. And that is true. I mean, the private sector is much better at spending and investing capital than the government, okay? And the government being in a better financial position it is overall a fantastic thing. Because yes, 10, 15, 20 years from now, we would have had a depression, right? We would have been in a very, very bad, crisis. Okay, so the government's trying to get ahead of that. That's a positive thing. Long run, that's great. Doge and less government, all of the Trump policies long run should be very favorable, right? Even some of the tariff policies, like we've always got ripped off on trade. To level that playing field, would be great. The issue is for investors that are currently putting capital to work, it's going to be tough for maybe a year, maybe a 2-year period. There will be a slowdown in economic activity. The question is how much of a slowdown, and we'll talk about that in just a moment. But Besant goes on to say, quote, "I've been in the investment business for 35 years, and I can tell you that corrections are healthy. They're normal," he said. "What's not healthy is straight up. And that you get these euphoric markets. That's how you get a financial crisis. It would have been much healthier if someone had put the brakes on in 06, 07. We wouldn't have had the problems in 08. He said, quote, "I'm not worried about the markets. Over the long run, if we put good tax policies in place, deregulation and energy security, the markets will do great." Besant added, quote, I say that 1 week does not the market make." Kind of a weird way to say that, but we understand, right? Long term, this is great. Short term, it's a problem because we've talked about this for years on the channel. Like in 2022 and 2023, we probably would have had a recession by now if the government was not spending like crazy. Like the amount of money the government has been spending is at an all-time high if you're not in a war, right? If you're in like World War I, World War II, like that's the kind of spending the government is doing. That is a crazy amount of stimulus. Now, it works weird, okay? So the government gives out essentially this money, and yes, the government has 3 million employees, but how many people were relying on government spending, right? How many businesses are reliant on that? What's the consequence of stopping that? Do you see, companies go under? How many layoffs do you see? There's a lot of uncertainty there, but less government spending is not going to be good in the short term. We know that as a fact. Question is the underlying economy strong enough to, essentially absorb that? And I don't think so. It doesn't look like it at this point. And that's why I've been so cautious and defensive on markets in recent weeks. Now, first and foremost, starting off tomorrow morning, you're going to get retail sales month over month for the month of February. January's retail sales were negative 0.9%. You're expecting positive 0.7%, okay? You're coming off of a really negative number. So positive 0.7% is like, that's okay, but it's not super strong at the same time, okay? If you were to get something over 1%, then you start talking about positive territory for January and February. The issue would be if this number comes in really bad. Now, we've kind of gotten a heads up of this, that could happen. Why? Well, retailers. I mean, Target, Walmart, Abercrombie, Best Buy, Macy's, Home Depot, TJX, Kohl's, Dollar General, Ross, even Delta, Starbucks, McDonald's, Ford, Lowe's. These are just the biggest well-known companies that have warned about a consumer slowing down, that have either cut guidance or outright said consumers are slowing down. Even a company like Dollar General says all income earners that shop at Dollar General are trading lower, not just, lower income, but middle income, higher income, they're all trading lower. I don't think that is a good setup for retail sales coming tomorrow. And I think February's data is going to pick up more of that trade war concern, which will also be interesting. And if retail sales are bad tomorrow, you're going to bring up more of those recession fears. And as I've explained here on this channel before, you are not pricing in a recession. You're not even close to pricing in a recession. What you're actually seeing in recent weeks is what you've seen in 2022, right? Or really technically 2021, like July through October, all of your, recession vulnerable companies, all of your momentum stocks during that time sold off first. They sold off hard and dramatically, okay? It was a sign of a larger sell-off coming because of those recession fears. People said, oh yeah, I don't want to own a firm. It was a firm at the time, Tesla, right? These stocks started to top out and really roll over. in November or so, November of 2021. By the time you actually hit a market high in, January of 2022, Tesla, for instance, was already off as high over 20%. Okay, it's obviously been a lot more dramatic this time around, but you're seeing that same thing taking place. It is the first, out of, 9 innings in baseball, if you will, it's the first for actually pricing in a recession. Maybe the second. You've seen momentum really get sold off. But if you get more signs of this recession, it's going to start hitting more companies, right? More important companies, okay? Larger companies. A broader sell-off could ensue. Now, we did get that 2% bounce on Friday. It was with very low volume, and we know those are not typically sustainable bounces, right? Low volume bounces show a lack of conviction and usually fade. But if retail sales are good and there's less of a growth concern after tomorrow's data, you could see markets come up to this 200-day moving average around 570, okay? Which is about $8 higher on the SPY than where we are. But keep in mind, you've already bounced about 2.5% from the lows on Thursday, right? And if you get to that 200-day moving average, that's going to be a bounce of almost 4%. Now, tomorrow, you're also going to get business inventories month over month and the NAHB housing market index and retail inventories excluding autos month over month. You also get New York Empire State Manufacturing Index coming out tomorrow. So some secondary, smaller data points and catalyst and mix that together with retail sales. If a narrative starts to form, that's really what you want to be watching for. Now, Tuesday, building permits and housing starts come out. If this data is bad, again, that's going to lead to more concerns about people's spending habits that could continue to slow. And that data comes out Tuesday. Now, on Wednesday, you have the Fed. Jerome Powell gets up on the podium and does the speech and takes questions. There's going to be quite a few questions about a recession here. We want to see what Powell has to say. If Powell is steadfast bullish or if he's more kind of neutral, okay? That's going to be important for markets. But the biggest thing is the summary of economic projections. Now, if you don't know what this is the SEP. The last one came out December 18th. In fact, the last SEP on December 18th was not taken well by markets, okay? The S&P fell 3% that day. It opened actually pretty well at 601.95. So you were doing pretty good. By the end of the day, you closed at 584. You fell $16, $17 on the SPY that day. It was a 3% move. A lot of it happened after the SEP came out. So it was really the last 2 hours of the day were terrible. And then markets did consistently move lower after that. I believe this was only a 4%, 5% drop at the time, right? And then you kind of bounced up and now we're selling off again. So the new summary of economic projections, we really want to see what the Fed has to say about how many cuts they're going to do, right? What the interest rate longer term looks to be. And, last SEP, they raised those targets to 3%. For 2025, the GDP projection was raised up to 2.1% from 2%. That's probably going to get, I wouldn't even be surprised if it's cut in half, right? We come in at a 1% GDP forecast. And that's important coupled with rate cuts. Imagine this. If the Fed comes out and they say, yep, we're only expecting 1% GDP this year, but we're only expecting to cut twice. Keeping their prior, rate cut forecast. It's not exactly screaming recession, but it's not screaming the Fed's your friend either, that they're coming to help out the markets. Now, the Fed also did lower their unemployment forecast by the end of this year in the last SEP from 4.4% to 4.3%. What do they do with that? Do they raise that again? That's important. And they did raise their PCE inflation targets. I don't think they're going to raise them. They could a little bit, but they're already expecting, 2.5% PCE by the end of this year. That could be a pretty attainable target, but there's also that tariff uncertainty. And I think with the conference from Powell, it's going to be really neutral. Powell doesn't want to commit to more cuts. He doesn't want to commit to the economy weakening. he really doesn't want to commit to anything right now. And you can't really blame him when there's this much volatility. So I think the key to what happens to markets, at least in the second half of this upcoming week, is really going to come from this new summary of economic projections. On Thursday, we will get initial jobless claims expecting 224,000 and existing home sales. Again, more real estate data that'll be important for the overall economy. Like if you get real estate that starts to slip even further here, that in and of itself could be another big catalyst for markets. Now, Friday, we're not going to get much. You do have a speech from Fed Williams. So the economic data this week is really front-loaded in the first half of the week versus the second half of the week. And really starting off tomorrow morning, that's going to set the tone for at least tomorrow. Like retail sales is going to be a very important data point. And you also want to pay attention if the markets rally, even though the data is like really bad and rate cut odds do not move up, that's another validation of likely this is just a dead cat bounce, a bear market rally, if you will, without the bear market. Some people also made the point that last week was a pretty big options expiration. This upcoming week is a very big option expiration as well. And there's more volatility around those option expirations. Also, in this upcoming week, you have a lot more earnings. Now, Monday and Tuesday, you really don't have much. But Wednesday, you have General Mills in the morning, Ollie's, and after hours, Five Below, Joy. Thursday pre-market, you have Darden, that's like Olive Garden, right? Accenture, Jabal, and some other names. Thursday and after hours, that's really the big day. Micron, Nike, and FedEx. Okay, Nike, some of those tariffs, that could look pretty dismal. FedEx is also important because FedEx is usually seen as like a bellwether company. FedEx has had negative things to say about the economy for a long time. We'll see what they say about the economy now. If they have negative things to say, then that's something I will be paying attention to. I don't know how much the markets will pay attention to that, but I think it's, again, like Walmart, right? When Walmart gives you bad guidance or says something bad about the consumer, that's huge. If Wall Street pays attention or not, that's another question. Friday pre-market, you have NEO, for those of you guys that like China EVs, and Carnival. And Carnival is going to be important for really that travel, leisure, hospitality sector. If Carnival says demand is slowing down, then I would expect all of travel to really get hit. Beyond that, again, it's important to remember the CNN Fear and Greed Index is in extreme fear. Like, you're already pretty damn bearish. All of your categories are pretty much in extreme fear. Besides market volatility, that is neutral, and junk bond demand is currently in greed. You also have the percent of stocks trading above their 50-day moving average at 26.86%. Like, you're already super bearish here. The average stock has gotten decimated and is down like 20 or 30% from all-time highs already. So it's a lot worse than the index actually shows. And could you be due for a larger bounce? Probably. Like, I would not bet against that right now, but I do acknowledge that there is a lot of risk in this upcoming week. You also have a third straight week of bears being above 50%, really above 55%. The lowest you've been at in the last 3 weeks is 57%. The highest you've been at was almost 61%. So people are very bearish out there. The last time this happened was the lows of 2009. So a lot of people try to say, this is a great sign that we're just super bearish already and stocks can't go lower. That is not the case. And I would argue that is a really bad reason to be bullish on markets. I mean, you want to take in the new information. You want to take in new understandings of markets every single data set that comes out. So retail sales tomorrow could totally change the narrative around a growth scare, at least for the time being. Does that ultimately change the end outcome of do we have a recession or not? No. Is 1 month's retail sales data really that important? Not necessarily, but if it's really good, for an example, then that heavily dampens down some of that growth concern. Now, personally think it's Gonna be pretty bad. But even as you can see, like during COVID, right? You got really oversold on the first drop, but you ended up dropping like 3 times that first drop amount by the time you hit the lows. But you had a lot of bounces, you know, in between this crash. It was not a straight down sell-off, right? There was a lot of big ups and down days, like this 8.5% up day, this 5% up day, another 4% up day, another 4%, right? But you did have those 5, those 9, 11% drops that continued to send you to new lows. So the point I'm making is when you get oversold on the RSI, you tend to get a bounce. But after that bounce, you could sell off again to a newer low and still not have the RSI get that oversold. And you also seen this during 2022. So from a technical perspective, I see why we're bouncing, right? But does a bounce change, the issue, the growth scare, recession concerns? No. But on a bounce, I do want to short markets once we get to a certain level. In this case, if we break that 200-day moving average to the upside, I think after that break would be a good instance to short, to go out with a, maybe a put trade. Now, I'm not a financial advisor. I'm not a financial, anyone you should listen to for financial advice. That's for sure. So take it with a grain of salt. Now, for Tesla, I think you could get up to this 200-day moving average if the SPY gets up to the 200-day moving average as well. I think Tesla's going to far outpace to the upside. You're also sitting at that critical level around 250. If you get above that, I think you get more options that start to roll into the money and more traders that are going to jump back into the stock because you fell so fast. The upside was violent, the downside was violent. The upside is also going to be violent as well. Now, I think it's going to be difficult to get above that 200-day moving average, but if we do, I'm targeting that 310 level between that 325 level. If you get back up there, then I think it's time to slow down, some of the call buying, if you will. Maybe look at a put or two if your portfolio deems that worthy. Now, that's if this week is a good week. If it's a bad week, then you're going to fall to that $200 level, right? You hit that low around 217, sharply bounce back up. So it looks like 220 is going to be a solid level of support. That's kind of the gap up level that you've seen back in October 24th, 25th or so, right before the election. He started to gap up and to move higher. Seems like you got a lot of support that came in around that level. If you break below that, then you're headed to 190. Now, again, the last summary of economic projections from the Fed was December 18th, and the SPY dropped 3% in like 2 hours, okay? So anything can happen this week, and it all starts tomorrow with that retail sales data. So let me know what you guys think down below in the comment section. I think right now you want to have as much dry powder on the sidelines as you possibly can, while at the same time staying invested in this market. If you're bearish or you're bullish, that doesn't mean you're all in or all out this market, right? You could be bullish on markets and have cash on the sidelines. You can be or have a put in your portfolio, right? You can, like me, be not so bullish on markets, but be fully invested, because I understand I can be wrong. And if I'm wrong, and I think there's only a 50% chance of a recession, if there's no recession and I'm wrong, then stocks are going to do well, and I don't want to miss out on that upside. But in the event I'm right and we do start to slip closer towards recession and stocks fall, you want to have that cash on the sidelines to be able to take advantage of that. So I think a lot of people, especially obviously retail investors, they get confused when someone says they're bullish or bearish. They think it's all in one direction, right? No, that's not the case. I think you want to set yourself up to win-win no matter what happens to markets. So let me know what you guys think about this down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.